At Red Brick Mortgage Advisory, consultants are getting more inquiries about paying down mortgages now that higher interest rates look here to stay.
Everybody feels the pain when they receive a statement saying that the monthly installments have gone up. Yeah, and then they start thinking, oh, I should repay my loan to lower the interest being paid.
Paying off your mortgage in a lump sum could potentially save you tens of thousands in interest.
With home loan interest rates expected to increase further due to heightened expectations that the Fed will be increasing its US fund rates as well, it might make sense to a homeowner to try to accelerate his mortgage repayments. Another benefit might be lowering your current mortgage service ratio and total debt servicing ratio percentage. By doing so, you actually increase borrowing opportunities.
With no more payments to make, you will also free up cash monthly that could be put towards other expenses. Beyond financials, it could also provide peace of mind.
A lot of people tell me, Clive, I just want to be debt-free. I don't want to have the burden of having a mortgage at the back of my mind. I don't want to have owe money to the banks. That is generally the most common kind of answer I'm getting.
But paying down your mortgage is not always the best option. That's because not all debts are equal.
So good debt is debt that is financing an asset, which is appreciating, right? And as you pay down some of that debt over the years, the value of that asset has increased. And this is exactly what a house is, right? A mortgage. While bad debt is your consumer debt, you're paying your credit card bills, your interest on your unpaid credit card bills, or even a car.
Debt such as mortgage can help you leverage your wealth to increase your net worth, while still keeping funds available for other investments or for a rainy day. On the other hand, paying off your mortgage means a significant chunk of your net worth is now illiquid. And that could cause financial stress in the event of shocks such as losing a job or a medical complication.
If you're staying in HDB and you decide to partially repay off the loan, you have to understand that once that equity goes into the property, you can't get it back later. The only time that you can get it back is when you sell off the property. So in between, if you need access to that cash, sorry, you can't get it back. If it's a private property, yes, when you put in this amount of money into the property, you can still get it back later in the form of an equity term loan. But when you are taking out an equity term loan from the property, then you're subjected to whatever regulations that govern mortgage lending.
In addition, you might be putting yourself at risk by putting all your eggs in one basket.
With anything, investments, you always want to stay diversified. If you've bought the property, for example, at $1 million, and 5 years later, your property is still at $1 million, you technically would have lost money, right? So that investment, that $1 million that you've put in, actually give you a negative return.
In this inflationary environment, putting a chunk of your cash towards your mortgage could also mean that you are missing out on higher returns elsewhere.
So one of the main concerns would be opportunity costs. A homeowner who is also an investor might want to compare their repayments of mortgage to their current investment vehicles, which might offer higher returns than the current mortgage rate.
Take, for instance, a lump sum of $500,000. Assuming your lock-in period is over, you could use the money to pay off a home loan with 20 years left at an interest rate of 3.5%. You would be saving close to $200,000 over the 2-decade period. But there is an opportunity cost. For instance, if you invested the same amount in, say, an S&P 500 ETF, you could make over $1 million over that same time period, assuming an average return of 6%, though you will have to deal with volatility along the way. Instead of paying down your mortgage, one option is to invest in low-risk instruments like money market funds.
So often when people choose not to pay up a mortgage, they still feel comfortable having cash, because in the event that interest rates go up higher, you can pay it off if need be, or pay down. So very often people end up putting money in fixed deposits or in fixed income-like instruments with fixed maturities. So that actually is a good strategy now, because their cash funds, money market funds, paying close to 4%. and they're liquid.
To enjoy the best of both worlds, you could also make a partial repayment of your loan. That way, you can lower your overall interest costs while ensuring you still have spare funds.
And very often what they do is they may pay up an amount that causes their monthly repayment to be the same as what it is now while they're on their lower rate package. So that might be maybe paying up, I don't know, if it's a $2 million mortgage, maybe paying up $200,000. And then it compensates for your increase in interest rate such that they are paying the same amount monthly. And then they feel comfortable, right? They're still having the same net cash outflow. And it doesn't change much of their day-to-day life.
An interest offset account can also offer you similar flexibility. This is a repayment account tied to your mortgage. It pays the same deposit interest as your mortgage rate, so offsetting the loan interest. The offset is capped at a certain ratio. Ultimately, it's key to remember that interest rates move in cycles. So instead of overcommitting to paying off a home loan, take into consideration your financial needs over the medium to long term before coming to a decision.
Always consider 3, 4, 5 years down the road, what is your cash flow? If you are aspiring, for example, to be a business owner, and you need access to a certain amount of cash 3, 4 years down the road, then you've got to think 3, 4 years down the road and look back to see whether the decision of paying down on a mortgage is a sensible one today.